I'd like to start the day with the stock of the day, Southern Cross Electrical Engineering. Look, we could have gone bigger today with Macquarie Telecom, which is raising capital for data centers. NextDC, as you know, raised more than $1 billion to really invest in data center infrastructure just last week. But Southern Cross Electrical is a company that's also leveraging the data center demand theme, but it's doing so by providing services for data centers, this time via its subsidiary Heyday, which has won contract extensions at 2 data centers and also a bit of work at other sites in the ACT. Now, today's announcement worth approximately $50 million in total. So, is SXE, that's its ticker code, another way to gain exposure to the AI thematic, which will require so much data center power? And how is Southern Cross Electrical Engineering placed otherwise? Let's get to it, and I'll start with you on this one, Philip Pepe from Shawn Partners. Do you cover it?
No, but I cover the space. I've had them in a few times. It's a fascinating story. It's had a great share price increase from around December last year, or even January, 85 cents to around $1.20 today. Data centers is a growth industry. You know, it's been a growth industry for a long time. Plenty of companies have become billion-dollar companies because of the assets that they've put in place. But someone needs to build the assets. So industry data varies. They're all quite large, but estimates put the data center market in Australia at circa $6 billion US per annum. Some of them are larger, growing at about 10% per annum. About half the data center capital expenditure, up to half, is the actual electricals. They consume a lot of power that needs to be installed, and companies like Southern Cross Electrical actually do the installation. So the equipment that's required, they actually roll it out and put it in. So they're exposed to a growth sector. The difference is, before today, they were trading at 12 times PE. Some of the other companies are trading at a lot more. So the company that's in the last 4 years, they've won about $120 million worth of work in the space. Add another 50 mil today, that puts it at 170. You know, and they're tendering on over 500 million in terms of work in the space. There's a lot of work out there, and I suspect analysts who do cover it will probably upgrading the stock today.
Well, sorry to interrupt, but you know, if you hear that NextDC is going to be pumping money in, you know, Macquarie Telecom, all of these data centers require Microsoft. You know, they require all of that copper for all the electricity. You know, there's got to be workaround.
And for several years worth. Again, there's multiple $1 billion worth of work out there. I think Microsoft alone is spending $5 billion in Australia over 2 or 3 years. So, and that's just one customer alone. So it will eventually come to an end, but probably not in the next 3 to 5 years. And yes, you can play NextDC, you can play some of the others. Goodman Group is moving into data centers. Most of them are trading at a premium to where Southern Cross Electrical was on consensus forecasts on 12 times PE before today. So I suspect there'll be some upgrades over before today. So I like the space. The company has been delivering, you know, transitioning from a company predominantly servicing the mining sector in WA, very convincingly moved to the East Coast market. So I suspect it'll win more fans today compared to even a month ago. So yeah, I'd call it a buy. I think there'll be some upgrades post today's trading update.
Thank you, Southern Cross Electrical Engineering. It's a mouthful. Mark, we do as investors need to consider, you know, other ways to play some of these major thematics, particularly here in Australia where we don't have those, you know, mega cap tech companies. So how does it look on the filters?
Pretty good, actually. It's the PE's in the top quartile at the moment at 15, which is a bit high for it. But their EPS growth rate's been running at an average of about 13% over the last 6 years, so which is pretty good. They've got about 4% net profit margin, which is not really high. For us, we've sort of cooled off on engineering companies generally. There's been quite a few that have got into trouble where if they make a mistake in their tendering and so on, or there's execution risk, if you like. But I think Philip's right in that the data center business has a very, very strong tailwind, and there's obviously plenty of work happening, which that can, by the way, that goes a long way towards covering up any glitches you might have. So we're showing it returning 18% a year at the current price, based on it maintaining its growth rate going forward, which I think is a reasonable thing. Margin of safety is about 6%. If I was going to look at this, I'd probably want 10% on a margin of safety, and that puts the share price at 94 cents. It's currently $1.13 yesterday.
Okay, so you just think you would like to pay less for it?
Yeah, but it's quite a good company, and it's got a good history, and I think it's in a good space.
So can we call it a buy from you today?
If you're going to twist my arm, yes.
Yes, all right. Well, our investment committee will discuss it. It doesn't mean that it goes right into the fantasy portfolio. As you well know, Mark, you've participated in many of those committee meetings. But yeah, I think it's worth a chat, if I dare say myself. All right.